Welcome to a new deep dive. Today we're plunging into a topic that touches nearly every single one of us: investing. We've been handed an incredible collection of sources, including insightful excerpts from the highly praised book Smarter Investing, Simpler Decisions for Better Results by Tim Hale. Our mission for you today is clear. We want to cut through all the noise and misinformation in the investment world, give you a true shortcut to sensible strategies, and equip you with insights that genuinely empower your financial decisions.
Exactly. And we're going to unpack what it really means to invest effectively. Moving well beyond the hype and zeroing in on solid evidence and common sense. This deep dive will highlight why embracing simplicity often leads to far superior outcomes, and crucially, how you can avoid those all too common pitfalls that snag so many investors.
Okay, let's unpack this then. The source highlights Smarter Investing as a guide to investing as well and as simply as possible, right? Explicitly designed to cut through noise and downright misinformation.
Mm.
And it's not just some niche read. It's highly praised by figures like Lars Kreuger, Brett Davidson, who famously gives it to friends and family, and even John C. Bogle, the founder of Vanguard, who called it a book of investment wisdom and common sense for the ages. That's quite the endorsement.
It really is. And what truly stands out here is the unwavering emphasis on evidence. The author, Tim Hale, brings, 3 decades of industry experience, and his company, Albion Strategic Consulting, manages around $18 billion in client assets. That's serious. He likens building an investment case to presenting before a court of law. It simply must be based on evidence and proven theory, not hearsay, gut feelings, or, anecdotes.
Right. Evidence, not just stories.
Precisely. So this makes me wonder, for you listening, how much of your current understanding of investing is truly built on solid evidence versus what you've just heard through the grapevine?
That's a really critical question because it feels like so much out there is just noise. I mean, everywhere you look online, people are selling these surefire ways to get rich quick. Our sources call this snake oil.
Snake oil.
It reminds me of Dory from Finding Nemo. Sometimes the best advice, especially when navigating complex markets, is simply to just keep swimming through the hype and focus on what's real.
It's important to connect that snake oil to the bigger picture of historical data, which frankly reveals a bombshell.
Right.
For instance, Jim Lorry's CRSP data, meticulously compiled way back in the 1960s, showed that if you'd invested in all New York Stock Exchange stocks from 1926 to 1960 and reinvested your dividends, you would have yielded a phenomenal 9% annually.
9% a year over that whole period.
Yes. And even investing right at the 1929 peak, amidst crashes and wars, still returned 7.7% annually by 1960.
Wow.
It really makes one wonder, if historical market returns are so powerful over the long term, why do so many people get lured into chasing short-term gains?
That's a question I think many listeners wrestle with, especially when the lure of quick profits is so strong. But what's truly eye-opening and where it gets really interesting is when you compare those active short-term chases to something as seemingly safe as just holding cash.
Right. The safety of cash.
Exactly. Our sources reveal that from 2000 to 2022, £1,000 invested according to Smarter Investing Principles. That's a sensible mix of 60% diversified equities and 40% bonds turned into over £2,350 after inflation.
Okay, so more than doubled, inflation adjusted.
Yeah, but that same £1,000 in cash deposits, it actually shrank to only £930.
Lost value.
Lost purchasing power. So cash, in this context, hardly seems like a safe investment at all. I mean, that difference is just staggering.
It absolutely is. And this brings us to a core problem often overlooked: excessive industry costs. The average on-the-road cost of a global equity fund trying to beat the market is around 1.2% in the UK.
1.2%. Doesn't sound huge initially, but...
Yeah. But when global equities historically yield about 5% real return, the investment industry, like a croupier at a casino, ends up taking almost 25% of your potential returns.
A quarter, just in fees.
Just in fees and other costs, yeah. As Nobel Prize winner Professor William Sharpe famously quipped, the laws of arithmetic have been suspended for the convenience of those who pursue their careers as active managers.
It's brilliant.
It highlights the stark truth here. Lowering your costs is one of the most guaranteed ways to boost your long-term wealth. Lower cost or passive funds statistically beat the vast majority of higher cost active funds over long run. It's a zero-sum game, less costs.
That sounds almost too good to be true, though. I mean, if it's that simple, why isn't everyone just doing passive investing? What's the main resistance or the big argument against it that people often make?
That's a great question, and it often boils down to a few things. First, there's the allure, the hope of finding that one genius manager who can beat the market despite the evidence.
The superstar manager myth.
Exactly. Second, the financial industry itself has a vested interest in selling more complex, higher fee products because, well, that's how they make more money.
Makes sense.
And third, there's often just a fundamental misunderstanding of the odds. You might think professionals can beat the market, but the odds are really poor. The SBVA US scorecard study, for example, it's been running for 20 years now.
Okay.
It shows less than 10% of active funds in almost every broad category actually beat their benchmark over that time, less than 10%.
That's incredibly low.
And only around 30% even survived the entire 20-year period. Many just disappear or merge away.
So most fail, and many don't even stick around.
Precisely. You also learn that only a tiny number of companies, like less than 4%, drive most of the market's wealth creation over time.
So picking those winners is like finding a needle in a haystack.
A very, very big haystack. You're betting against extremely long odds trying to pick individual stocks or active managers who can consistently pick them.
And it's striking to see how even those famed star fund managers, the ones who get all the headlines.
Oh yeah, the Bill Millers, Bill Grosses.
Right. Anthony Bolton, Neil Woodford, initially celebrated, but often analysis over their full tenures showed underperformance compared to simple index funds. Or they faced huge issues, like Woodford's fund closures.
They became cautionary tales, didn't they? Rather than blueprints for success.
Exactly.
It's compelling data, which really makes you consider why, despite all this overwhelming evidence, do we still chase the promise of star managers?
Human nature, maybe? Hope.
Perhaps it's our deeply ingrained human desire for a hero or, a shortcut.
Which, this brings us to a crucial point the book makes. Smarter investing is not about gambling with your money. The sources emphasize that gambling involves looking for long shots with high payouts, like trying to pick those outperforming stocks or managers. As the author puts it, you are entering a casino if you adopt such an approach, and one in which the croupier has a big fat hand in your pocket.
That's a powerful image. And the most jarring insight, I think, from how we actually invest versus how we should invest is called the behavior gap.
The behavior gap.
Okay, basically, our own emotions, our reactions can cost us a staggering amount, maybe a quarter to nearly half of our potential returns from equities.
Really?
That much.
Yeah. For example, the ARKK fund, remember all the hype, it saw peak inflows right at peak performance.
Oh, I remember that.
Only to see massive outflows as performance plummeted by 77%. People bought high, sold low. And another example, the CMG Focus Fund had an amazing 18% annual return on paper. But the average investor in the fund actually received a shocking minus 11% annual return.
Minus 11? How?
Because they piled in at the top and bailed out near the bottom. This persistent gap, costing maybe 1–2% annually across all kinds of funds, just eats away returns.
Wow.
It highlights the core takeaway.
Yeah.
Your biggest investment hurdle often isn't the market, it's your own mind, it's you.
So what does this all mean? Our minds battle between that reflective, logical part and the intuitive, emotional part.
Yeah, System 1 and System 2 thinking, as Kahneman would say. Right. And the intuitive side often wins out, leading to panic and elation that just damages wealth. Buying high, selling low. Think of that lion jumping at zoo bars analogy the book uses.
Yeah.
Your immediate illogical scream reaction.
Exactly. That intuitive decision-making is just prone to illusions, biases, and taking inappropriate risks.
That lion analogy is so vivid. It really nails how quickly our intuitive brain can hijack our logic. I sometimes catch myself doing it even now. What's your go-to mental checkpoint when you feel those emotions creeping in?
That's a great question. For me, it's always about pausing and asking, is this decision based on my long-term plan, or is it a knee-jerk reaction to current headlines or emotions?
Yeah.
It's about sticking to the plan. A study of Charles Schwab clients actually revealed these common biases.
Oh, yeah. What did they find?
Recency bias, giving too much weight to recent events, topped the list at 60%, followed by loss aversion, hating losses more than enjoying gains, and confirmation bias, just looking for info that confirms what you already believe.
And social media must pour fuel on that fire.
Oh, absolutely. It just exacerbates this. And then there's overconfidence, the illusion that you have better insight or control than you really do, leads to concentrated, risky portfolios. As Charlie Munger wisely said, the big money is not in the buying and selling, but in the waiting.
The waiting. Patience again.
Exactly. So for you listening, a key question to ponder is, how can you manage yourself as tightly, maybe even more tightly, than you manage your investments?
The key according to the sources, is to manage those emotions by having a disciplined, unemotional investment process, a system.
A system, right.
Systematically rebalancing your portfolio, for instance. It forces you to sell assets that have done well, sell high, and reinvest in those that haven't, buy low, without relying on emotional forecasts about what's going to happen next.
You're taking the emotion out of it.
Exactly. It's about letting the probabilities work in your favor consistently over time.
Okay, so now that you're prepared to control your emotions, or at least try, we can talk about building a sensible portfolio. The reality is you have to take on some risks to grow your wealth over the long term. You can't avoid it entirely.
Right. Risk and return are linked.
But diversification truly is investing's only free lunch. It's fundamentally about managing and mitigating risk without necessarily sacrificing expected return.
I like that free lunch idea. And this is like the British Olympic cycling team's success, wasn't it? Built on the aggregation of marginal gains.
Good analogy.
It's not about one big secret weapon, but lots of small, consistent improvements adding up. For your portfolio, this translates to building a mix of growth assets, like global equity,
Basically.
and defensive assets, like high-quality, shorter-dated bonds, rather than putting all your eggs in one volatile basket.
And your long-term investment policy or strategic asset allocation, that's the fancy term for your target mix, is absolutely critical. It drives most of your return variability. Mainstream assets like global equities, maybe some real estate through REITs, and those defensive bonds typically form sensible portfolios. It's generally advised to avoid the really sophisticated stuff like hedge funds or commodities. They're often complex, costly, and the extra risk isn't always rewarded.
Keep it simple seems to be the theme.
Pretty much.
And a central idea here is to be truly global in your equity allocation. Don't just stick to your home country.
Absolutely crucial. Home bias is a big trap.
Yeah, many companies like the FTSE 100 here in the UK has something like 80% overseas earnings, or the S&P 500 in the US has over 40% outside the USA. They're multinational giants anyway. But diversifying away from just one country's market is crucial. Just look at Japan's market.
Oh, the lost decades.
Right, it languished like 60% below its 1989 peak for over a decade. Sticking only to your home market can be a significant blind spot.
Definitely. So while you can certainly hold a simple global market cap weighted portfolio, just own the world market,
The easiest way.
you might also consider what the book calls small but meaningful tilts. This means slightly overweighting certain types of stocks, like smaller companies or value companies, those trading at lower prices relative to their fundamentals, or listed real estate investment trusts, REITs.
Why those specifically?
Because academically, these asset classes have historically shown higher expected returns over the very long term, and they can provide additional diversification benefits because they don't always move perfectly in sync with the broader market.
Okay, so it's not about timing the market.
Absolutely not. This isn't about market timing. It's a strategic, long-term allocation decision based on robust evidence about expected returns.
Got it. Okay, let's shift gears slightly. Sustainable investing, ESG. It's a huge topic now.
Huge. And our sources dive into its complexities.
We all care about climate change, inequality, corporate governance, right? But translating those values into investment decisions isn't always straightforward. I mean, the UN has those 17 Sustainable Development Goals. Few people would disagree with the aims.
True. But what's crucial to understand here, and the book is quite direct about this, is the distinction between having a portfolio that reflects your values
Okay.
and making a direct, measurable impact with your investment choices in the public markets. The source stresses that, for example, not owning fossil fuel stocks does not decrease fossil fuel use.
How so?
Because when you sell shares in the secondary market, just selling shares, you already own, someone else simply buys them. Often, they might buy them at a lower price if lots of people are selling.
So the company still exists, still operates.
Exactly. The ownership just changes hands. And this means investors who care less about ESG factors might actually get more in potential returns by buying those shunned stocks cheaper.
That's a difficult trade-off.
It is. So for you, a key balancing act to consider is, how do you balance your financial goals with your ethical beliefs in a way that's actually tangible and effective?
The book describes the impact of simply divesting selling shares as marginal, indirect, unidentifiable, and unmeasurable.
That's strong words.
Yeah, it presents a powerful analogy. Investing sustainably by just avoiding certain stocks is not the same as actually not burning petrol in your car or turning down the thermostat in your house. Those are direct actions. It warns against misleading claims some funds make about CO2 saved by a portfolio, suggesting it risks making investors feel they're doing enough through their investments alone, without considering perhaps more impactful consumer choices or actions.
And where true impact from an investment perspective often comes through, according to the source, is engagement or stewardship.
Engagement. What does that mean?
It means using your shareholder rights. Especially large passive firms like Vanguard or BlackRock, who own huge stakes in companies across the board. They can actively influence corporate agendas, voting on proposals, pushing for changes, maybe even forcing environmentalists onto a board, as happened with ExxonMobil.
So using their clout as major owners.
Exactly. That's where the leverage often lies. So for you, the key is to be clear-eyed about these hard trade-offs between financial return, expressing values, and achieving direct social or environmental impact through your portfolio choices.
Right. Okay. So you've got your philosophy sorted. You're trying to manage your emotions. You know how to build a robust, diversified portfolio.
All right.
What about the practicalities? Actually doing it.
Good question. The sources guide you to choose sensible, broad market indices for each asset class you decide to include. Think FTSE Global All Cap for equities, maybe a global aggregate bond index. Start with major, reputable index providers.
And then you need the actual products, the funds or ETFs.
Yes. And when it comes to product choices, remember this warning. Just because a fund or ETF is passively managed does not mean that it necessarily holds the investing moral high ground. Meaning there are some shockingly structured and costly systematic or passive-ish products out there. They might track an index, but do it badly, or charge too much, or use derivatives in complex ways.
So even with passive, you need to check under the hood.
Absolutely. You need to do your homework on the specific fund or ETF, check its costs, its tracking difference, how it achieves its exposure. This leads to an important decision point for you. Will you take a DIY approach, do it all yourself? Or will you hire a financial advisor or planner?
What's the guidance there? The source notes that if the money you're investing is, say, a smaller nest egg or maybe just contributions into your workplace defined contribution pension, where the options might be limited anyway, a DIY approach might make perfect sense.
Keep it simple and low cost yourself.
Exactly. However, if you need a comprehensive, robust, lifetime financial plan, dealing with retirement planning, inheritance tax, complex goals, then a high-quality financial planner can be invaluable.
Taking the burden off you.
Yeah, they can help you relax about your wealth, handle those complexities, the administration, and importantly, help you stick to the plan during turbulent times. They act as that behavioral coach too.
Whichever path you choose, DIY or advised, an online brokerage platform will likely be your conduit to the markets. Select major, reputable platforms. Look for ones with sizable assets under administration and established revenues, for peace of mind that they're likely to be around for the long haul.
Good point. Security matters.
And never ever forget about tax.
Yes. The tax wrapper.
Definitely. Legally paying tax later, or ideally minimizing it or avoiding it altogether through legitimate means, can have a significant beneficial effect on your total portfolio returns over the long run. This obviously includes utilizing tax-advantaged accounts like pensions and ISAs here in the UK, or 401ks and IRAs in the US. Use those allowances as much as possible.
Makes a huge difference over decades.
Massive.
So once everything is finally set up, the plan, the accounts, the investments, what's the advice then? Check it every day.
Definitely not. The advice is surprisingly simple. Look at your portfolio annually at most.
Once a year, that's it.
Maybe when you do your rebalancing. Any more frequently, and you'll probably just shock yourself with the inevitable ups and downs. You'll see too much volatility, too much noise.
And be tempted to tinker.
Exactly. Tempted to react emotionally. Time, patience, and sticking to your strategic plan do a remarkably good job at smoothing out the bumps in the road. Let compounding work its magic.
So wrapping this up, this deep dive has really highlighted that smarter investing, according to Tim Hale in the evidence, is truly about making simpler, evidence-based decisions. It's about controlling your emotions, or at least managing them.
A constant battle.
And building a robust, diversified portfolio for the long term. It's really not about chasing the next hot tip or trying to outsmart the market. It seems to be about consistency and discipline.
Indeed. We've seen how costs relentlessly erode returns, how our own behavioral biases can sabotage even the best intentions, and how incredibly difficult, statistically improbable, it is for even professional active managers to consistently outperform simple, low-cost index funds. The data, time and time again, consistently points towards a patient, low-cost, broadly diversified approach as the winning strategy for most people.
So what does this all mean for you listening? I guess as Warren Buffett famously put it, the stock market is a device for transferring money from the impatient to the patient.
That sums it up beautifully. So, as we finish this deep dive, perhaps it leaves us with a final provocative thought to consider. In a world that's constantly pushing for instant gratification, complexity, the next new thing, are you willing to embrace the, frankly, quite boring simplicity and patience that history consistently suggests are the true hallmarks of long term investment success?